In this, our last video, our 10th week video, I think I'm going to go off book. A bit off script, a bit out of the Gwartney textbook, and talk a little bit about something that maybe you all have been wondering about, hearing about over time, and it is the Great Recession. uh, that I call the we've heard the Great Recession, the financial meltdown of 2007 to 14. 2007, 2009 was the start of the recovery. But what were the causes? What happened? Today we have involved ourselves in a colossal model, having blundered in the control of a delicate machine, the workings of which we don't understand. The result is that our possibilities of wealth may run to waste for a time, perhaps for a long time. That was a quote from John Maynard Keynes back in 1930. As I've said before, John Maynard Keynes wrote the book and established a whole school of economic thought that we call Keynesian economics, where it's one of the fundamental points is that the aggregate demand, aggregate supply. We look at aggregate supply in the near and short run, and the long run will take care of itself. That's why the long run aggregate supply curve is a vertical line, and it will always flow back to that optimal, full employment of all resources, natural rate. Well, we will always get back there, but it may be an increase or a decrease in the price levels to get there. But we will always get back to that point. And since the economy will flow back through the certain mechanisms, we only need to do the short term or short run mechanisms to fix what's going on today. And so Keynesian economics fundamentally is worried about the short run. The long run will work itself out. And this is really what John Maynard Keynes was referring to in this muddle, the colossal muddle that we have blundered into, is the Great Depression. So we have the Great Recession and the Great Depression. And the Great Depression is from 1929 to 1935, and he's referring to that. He's in the middle of that. It was considered one of the most significant events in the economic history of the world. It's the worst crisis since the Great Depression. Now, before we get into the various causes, I want to start off with discussing Kendallberg-Minsky model of manias and panics. Hyman Minsky in the late 70s followed or looked at created a model that all financial meltdowns throughout history, financial crises throughout history, and this goes back to the tulip bubble of 1637, the earliest recorded bubble mania panic that we hear about. But there have been others throughout history. There was the South Seas bubble, and there was the French banking bubble, for instance. There was the bubble that was the Great Depression, for instance. The the dot-com bubble. Each of these bubbles or each of these financial crises have a particular pattern that Hyman Minsky and Kindleberg actually were able to develop. Hyman Minsky and Charles Kindleberger. And so it's called the Hyman Minsky Kindleberger, the Kindleberger Minsky model. So there are 7 stages to a panic or or 7 stages to a financial crisis. And there is no, the model doesn't dictate how long each of these stages last, but they all follow a specific particular type of pattern. Stage one is called a displacement. A displacement is a fancy term for something new that nobody really knows about. Um, Whether it's the fact of a joint stock company, which was part of the reason for the South Sea bubble in the 1700s. The creation of a what's called a joint stock company, or being able to sell stock in a company without actually being an owner, a stockholder versus an owner, slightly different relationship. That was a displacement because the stock itself was a new concept. What was new in the Great Depression was the ease of credit. That was one that was really hit hard. What was the displacement in the dot-com bubble of 2000? That was the dot-com companies, which were brand new. The internet was exploding. A lot of these dot-com companies were going into starting up for a variety of services, and it was a completely new, innovative thing. And I'll explain later what the innovation was for the Great Recession. But usually it's financial. The Great Tulip Bubble of 1637, the displacement was a futures contract. The growers of tulips in Holland, which was the only place in Europe you could get it in 1637. That does predate the birth of the United States in 1776. The Pilgrims were here. There were colonies, but there were not much going on in the United States yet. There wasn't even a United States. It was just the colonies. So Europe was still the major economic player, or the countries of Europe were the major economic players in the world. England, Ireland, Scotland, Spain, Portugal, and Holland, France, Germany, Holland. And Holland had a significant position in the marketplace because of a unique thing called a tulip. And in the spring, we see tulips all over. If you ever have a chance to visit Holland, Michigan in early May for the Tulip Festival, where there's tulips all over Holland, Michigan, transplanted directly from Holland, the country, with settlers that settled on the west side of Michigan and called their little town Holland. And it's got a Dutch feel. And so it became, and by 1637, the tulip, and there was particularly there were two particular species of tulips that became very, very popular by several different the rich aristocracy, specifically the King of England. Louis XIV was very fond of the tulips, and he bought so many thousands and thousands of tulips to plant at Versailles, for instance. Um, so the thing is that tulips are grown and are planted in the spring, and the bulbs can be replanted and they come back again the following year. But it does take years for tulips to grow from a seed. So the bulbs were very, very, very popular. So what was happening was the growers of tulips were selling the bulbs for future. In the fall, they were selling the bulbs, or at least they were selling the yield from their bulbs saying that I will be able to get 1,000 flowers or 100 flowers or 10 flowers, and people were buying the future of being able to purchase. That's the future. What a future contract is: the buying the right to buy a certain number at a particular price. So they were willing to buy tulips at a lower price if you pay for the right today. So they were anticipating buying tulips, the grown tulips in the spring. But what happened was that the seller or growers were overselling the tulips. So they were selling futures, same crop to many different people just for the money. And that created more and more of the boom. There's the boom we have. So the excitement started around the tulips around September of 1636, really. And because the bulbs were no longer really available as they are in the ground, you couldn't tell what they looked like, whether they were going to bloom. Um, so they committed to buying this future purchase in the spring. But as since there's a limited number of bulbs, and as I said, they tried to oversell it, the people were willing to pay more for that future crop. So I say I'm going to pay $5 for it, and then the next person says, well, if he's going to pay you $5, I'll pay you $10. Already that future is doubled in price. Well, I'll pay $20. Now it's doubled, it's quadrupled in price, and so on, because people, there's only that one person wants it. Everybody wants it, but there's only a certain amount. That's what I'm trying to say. So the boom is this price that I just, in my little example, has quadrupled in price in a very few, in 2 seconds. In 2 seconds, it's quadrupled in price. That's the boom. The boom is the start of a rapid growth of speculate before the speculation, but the rapid growth in the number of contracts or the number of people wanting to buy into this new innovation. So the boom is the rapid expansion of these contracts, of this displacement that perpetuates through the population, through whether it's the investors or it's home buyers or whatever the population that's involved. And the speculation stage is, as the boom is increasing, the speculation is that the prices are going to continue to go up. So now I'm investing it for a quick profit taking. I'm going to buy it low and sell it high because it's going up so fast, says the individual. And this leads to the mania where more people are seeing, oh, the price is going up. I better jump on the bandwagon. This is the bandwagon mentality, the lemming mentality, where the leader is the speculation and the speculator, and the speculator has decided I'm going to start in the as a leader, pick up on this invention, this displacement, this new financial instrument, and the mania is the lemmings following suit, following along, doing the same thing, and that continues and increases the price. So the price continues to go up. And this in parallel, and as you see on the right section, is where the banking and financial industry comes in, where I would love to pay $1,000 for that stock right now because it's worth $1,000. I'd like to buy a bunch of stock for $1,000, but I don't have $1,000. So where am I going to get $1,000? Well, you go to financial institutions like banks and say, I want to borrow money. Now, banks aren't going to necessarily lend you money on a stock itself because they know the volatility, but they're going to take advantage of the fact that you're using this for something, you're gonna put up your house, you put up your car and borrow the money that way. Something that value whose value is going to stay static or hold its value, or the value will increase in time versus decrease in time, and there's a fundamental behind that asset. So the money is chasing the asset, where your money is chasing the financial asset. And that, again, the mania is this expansion of the market so that everyone is jumping on the bandwagon until someone starts to say, wait a minute, if I take a look at this stock, or if I take a look at the housing market, or I take a look at these tulips, how is it that this tulip costs so much money? It's a bulb, it's a flower. It doesn't make any sense. So I'm not going to, the leader now, a different leader perhaps, who is going to start to say, I don't think this is a logical, it's logically going up anymore. I'm going to start to sell. So the distress is that I really don't need to sell any. I don't need this anymore. It might be the profit taker that says, "Hey, it's gone up high enough. I think it's high enough. I'm going to start selling my stock, or I'm going to start selling that financial instrument." The distress starts there, and more people start to sell. The price starts to go back down. And as this price is starting to go back down, the revulsion is, now I can't stand to have this stock. It stinks. It's a stinky stocky. And that stinky stock is, or stinky financial instrument is, I'm selling it. And as the people start to sell there, the price starts to go back down until there's a panic where, oh my goodness, I spent $10 on that. It's down to seven. I better sell it now because I won't lose as much. But if it goes down to zero, I'll lose everything. That's when the panic starts and the crash comes back down. And typically these stages flow up and down to almost where the displacement originally started selling. So very similar to the boom, the panic and the mania on crude oil in 2007 through 2008. In October of 2007, the price of crude, a barrel of crude was about $50, around $50 a barrel. By July of 2008, the price had risen up to $150 a barrel. And by October of 2008, guess what the price was? Back to $50. So the displacement is actually, in that case, the displacement was a supply shock. There was an idea that there was low supply, that the OPEC was going to reduce production in 2007. So it started a boom where a slight panic, but this is not the panic I referred to in the end. The panic of, oh no, where we're going to get our fuel or oil, we're going to start bidding. And so the bidding war happens. And it tripled in price in a matter of months, with no perceived end. So the boom continued. Speculation is it's going to continue to go up. So the mania is that the investors in this contract, or to buy crude oil, continued to bid up the contract price so that it became $150 a barrel by July. The distress starts when it doesn't make any sense. OPEC says we didn't cut production that much. Oh, well, it was, no, that's not the reason why the price went up. It wasn't OPEC. It was the demand in China and India. And China and India are saying we didn't change the way we drive cars. Yes, we have more than a third of the world's population in our countries, but the use of gasoline did not immediately or overnight change. It's gradually been increasing, but it hasn't changed overnight. And in the last few months, we have not changed our demand. So the supply demand fundamentals weren't even in that model, in the crude oil market. So nothing really worked, made sense. Then the distress was, I'm holding on to $150 barrel where I have a contract to buy it, that's not worth it. It's going to go down. So they start selling those contracts, and the price starts to go down. The revulsion, the price is too high. I'm not going to buy it. So that cuts the price even further and further until the panic is we can't. Nobody wants it at 150 anymore. Boom. Not Kindleberg's, Minsky's boom. My boom. We're back down to $50 a barrel. As we're coming down the backside of this bubble or backside of this curve, now it's the assets are not worth as much, so we can't pay back the credit. That's the credit is I borrowed $1,000 on my house to buy some stock, and now the value of the stock is less than $1,000. So if I sold my stock now, I'm not going to get my thousand back. So I can't pay back the loan. So now the asset, the stock I bought because of this bubble, I bought it at the wrong time. That's buying at the wrong time. Timing, I bought it at the wrong time. It's going down. I'm losing money. Even if I sold, I still have to pay this loan back. So now the asset is chasing the money, not the money chasing the asset. Before we get into the different causes of the Great Recession, I want to review quickly just the list of the 10 tenants, not David Tennant again. You see David Tennant there. Not David Tennant, but the 10 tenets of economics that I talked about in week one in our first video. We have the opportunity cost, the cost of the choice that was given up to pursue some activity. Rational people respond to incentives that rational people will cut coupons to and be incited to go to a store and buy more other items. People think at margin. What is one more item? What's one more basketball do to our system? What is making another basketball do to our costs? Voluntary exchange. We give up something that we want in return, and the other person, the other party, gives up something they have for what we are willing to give up. That voluntary exchange, and both sides are better off. Markets are a good way to organize economic activity. A centralized area where we can all meet together and exchange gifts and services or goods and services for money or some other product, but it's mostly money. Governments can sometimes improve economic outcomes. Sometimes it's a disaster. Country's standard of living is measured by the production of goods and services. We talked about GDP. Inflation is caused by government printing too much money. That's where government spending increases to a point beyond, or that deficit spending is greater. So the government borrows the money by issuing more bonds. That's in effect printing more money. The Federal Reserve also printing more money, quote unquote, by buying bonds and increasing the money supply. And consequently, that money supply increases, interest rates go down, government spending increases, GDP goes up by the consumption going up. The short run trade off between inflation and unemployment, according to the Phillips curve, that I believe he was Australian or New Zealand. I don't believe he was English, but William Phillips came up with the concept that he analyzed the relationship between the rate of inflation, the changes in price. As inflation goes up, unemployment goes down. And as unemployment goes up, the rate of inflation goes down. So there's an inverse relationship between the two. And I want to say that although these tenets are, as tenets are, written and they are the law, even though David Tennant is such a magical guy, it's unfortunate that everything we're going to talk about violates one of these or many of these tenets have been violated in order for the financial meltdown or the Great Recession to occur. So let's start off with Alan Greenspan's ideology. Basically, he was in charge of the financial sector, and he was also at that one time the most economic czar of the world. He he actually was a very laissez-faire classicist when economist. Alan Greenspan, also was a chair of the Federal Reserve at one point, and during the financial crisis, he was there at the beginning. Um, he actually did not believe in regulation. He wanted to deregulate the banking and did not see. Um, he believed in what's called the efficiency market hypothesis, that the markets with the available information and that's information available will move towards a optimal level, and regulation or government intervention is not necessary. Um, he actually, because of his um, oversight or lack thereof, he oversaw. I mean, he basically ignored um, many systemic problems. Um, what's called asymmetric information, where people had knowledge of things that were not public. Um, there were predatory loans that were going on. The mispricing of the risk of the loans were also going on, and this what was termed irrational exuberance during the financial for during the housing market. Part number two. These are all correlated pieces that I'm going to go over. These all had are parts of and aspects of the financial crisis. Each one had a contributing factor. Alan Greenspan, and as the head of the Federal Reserve, was one piece. The displacement that happened here was called the financial innovation. The displacement started this was what's called MBS, CDS, CDOs. MBS stands for mortgage-backed security. Um, they when a bank loans money on a mortgage, they have underwritten, basically they've decided, determined partly the risk, the probability of payment, repayment, and that loan is packaged in with other loans that are similar to that as a tier one or a top tier or a class A or a grade A loans package. And so the mortgage-backed security is all these little loans in a particular geographic area are all packaged together at the A rating. And there's a MBS for a B rating, and so on. The CDS, or collateral debt, um, I'm sorry, credit default swap. The credit default swap was an insurance policy that AIG, as an insurance company, actually got involved in the financial institution, saying, well, if I bet you, you pay an insurance to me, that that mortgage is going to pay, and if it doesn't, I will pay you. And so they pay a premium to a CDS, this credit default swap, and basically swapping the risk, mitigating the risk from the investor over to AIG. A CDO is a collateralized debt obligation. They took these MBSs and they started slicing them up and mixing them up out. So they take a pieces or some mortgages that were A's and B's and C's and mix them and made them into CDOs. Higher risk, higher return, more people wanting it. All these slicing and dicing that was going on um, contributed further because these were brand new. Nobody knew about them. So there was a lot of trust involved merely by the fact that they were new and innovative. The next thing was the displacement of the shadow banking system. We talked about in 13 and 14 about banks and the Federal Reserve and they the Federal Reserve was the bank's bank. So what I failed to mention in that video was that banks have to be members of the Federal Reserve to have its protection. It's a like a membership. Most banks in the United States are. The banks you think about, even if they are, if you don't know them, and even mid-sized and smaller banks participate in the Federal Reserve because of that. Um, the ACH, the OSH, the Automated Clearinghouse. If you have a check, you can't clear a check unless you're part of the Federal Reserve. So it's sort of a members-only clubhouse, which is the Federal Reserve members, but you can't do anything. If you're outside the membership, you can't do anything with a check. You can't do any interbank transactions. You can only do your own bank transactions with yourself, and there's no security behind the money. So a shadow banking system were these banks that actually didn't have money. People invested in the bank, and the bank loaned money out, but they didn't have any vault. They weren't part of, they were called investment banks. So they were outside of the Federal Reserve. And so because they were outside the Federal Reserve, they weren't regulated by the Federal Reserve. They weren't insured by the FDIC, the Federal Depository Insurance Corporation. So the monies that were invested in that, it was just an investment. So the investment bank would solicit investment and use that money to loan out to these jump on the housing market. Uh, but they were not part of the banking system. And another piece was the housing bubble itself, that the ease of credit, the ease of lending. These MBSs needed mortgages to back them. And without a mortgage, then there's no security. So bankers and the shadow banking system was also involved in this. They started doing more uh, predatory or subprime mortgage lending to incorporate and invest and package it as MBSs and sell them on the secondary market. The housing bubble, because prices were low. And so in the 90s, basically it started in the mid 90s, this housing bubble, and continued until about 2007. So it was about 10 years in the growth where builders were building more and more. So the supply of houses it was increasing. And as we looked at before in chapter 3 and 4, if we see that there's a positive shift in the supply curve because there was just a lot more, then the positive shift forces the equilibrium price or the prices to go down to meet the demand. So prices started falling, so it was became more and more available for people to buy houses. And coupled with that was this subprime lending and the predatory lending. These kind of go 4 and 5 go together in that more people were availed to houses, but didn't really have the traditional prime lending criteria. Good job, good credit, high enough income to low DTI, what's called DTI or debt to income ratios. All those criteria that mortgages, I was in mortgages many years ago. I was actually in the mortgage industry in the late 90s. By the way, I was in there from 90 to 97. I left and I was out of that in 97 just as the prices started to kick back up a little bit. So I was actually in it, but I was working for a bank, so we didn't do a lot of subprime lending. We maintained a high level. But nonetheless, the housing bubble was the low prices and people buying it because houses always appreciate. So the prices of the new construction was low, but everybody knows that property values and housing values always goes up. And so it's always a good investment to buy a house because you buy it low, it's always going to appreciate, and that facilitated that bubble. Um, and the lending, subprime really doesn't mean anything other than a prime loan is a loan that is granted to a prime lender or a prime borrower. The borrowers have good credit, in a good credit range. They have good jobs. They have a job that's verifiable. They have income from that job that's verifiable. The value of the property is reasonable for the market. Other criteria like that. Have been at the job for a number of years. Things like that. So these new houses of subprime would is one any one of those pieces are not to that same level. They may not have good income, or they may not have a good job, or the value of the property is not really high enough. That predatory lending started at 1%, where you would borrow and you're only paying 1% per year. But it was what's called an adjustable rate mortgage, or ARM, ARM. Adjustable rate mortgages actually was an invention in the 80s. Previous to that, all mortgages were fixed. But in the 80s, they opened up the adjustable rate, which adjusted based on some criteria, whether it was the prime lending rate, which is 3.25 currently, as of this recording, or was it based on the Treasury bill, the 6-month Treasury bill, or the yield on the Treasury bill. These were all different basis for the loan, and it would adjust, or the interest rate would change every periodically. And the predatory lending were under the Ninja loans. The Ninja is actually NINJA, no income, no job, no assets. That's what a Ninja loan is. It's a term for the type of predatory lending. We don't care if you have a job. We don't care if you have any income. If you're having problems getting a loan from anyone else, we'll do it. That's something that Countrywide Mortgage. You may not know that company anymore. It was the largest lender at this time. At the time, it was the largest mortgage lender in the country, and it folded up because of the predatory lending practices it did, and all the ninja loans they purported. Now, with these subprime loans, the loans that were under the credit requirements, under these ninja loans, no income, no job, no assets, the banks were packaging them up to be MBSs, and then they would send these MBSs to a third-party company. And these third-party companies would rate them. And we'll talk about the rating in a little bit. But the rating or the underwriting, the underwriting bank would actually say, this is a grade A loan, this is no problem, it's perfect, without disclosing the ninja part of it, that there was no income, no job, no assets, poor credit. They would construe a perfect loan when there wasn't one. That's the fraud in the underwriting. How can we get more loans, and how can we sell these loans so we get our money back? The more loans that the bank does, they sell them through the MBS or the CDO. They get packaged up and then sold in the secondary market, and then they get their money back. So the cycle keeps going, and then they loan more money. It's the violation here is of that tenant, that they're not thinking at margin, where one more loan is going to cost anything. The risk involved is not here. The the cost benefit analysis is very low, because the cost is very, very low for every one loan, because they immediately sell it and they get their money back. Most of the money back. Since they're getting their money back from the original loan amount, not the full interest total loan amount. I'm talking about the initial loan amount. The borrower borrows $100,000. The bank gets that 100,000 back when they sell it, because whoever buys that loan is going to hold it and earn the interest. So they get more than the 100,000 at the end because the interest is paid when it's paid off, and that's how banks get their money. The MBS is the innovation where it's not one loan, it's several loans packaged as one. So all the houses that are in this MBS, mortgage-backed security, are paying on that loan. Well, the fraud in the underwriting comes in when the underwriter is fraud is misrepresenting the value, the true value of that loan. It should be a B or a C, but he's calling it an A, and that's the chicanery we're talking about. Competition between lenders for revenue and market share contributed to these declining underwriting standards and the risky lending. Um, the we had a savings glut. Recall back to the loanable funds market that we talked about in chapter 13 and 14. The loanable funds market is not it's not part of this the money supply only, the cash. It is the money held by banks. It's the savings we do. So we had an excessive amount of savings, a lot of money sitting in banks, burning the holes in the in the banks, and they had to get rid of that somehow. So they reduced, but the demand for money was low because interest rates were high. So there was a high level of savings. More people were saving because the interest rates were higher. So you decide on saving more because you get a higher return on that savings amount. That interest is high. But that same interest, the higher interest, is too high for a borrower. So there's more money sitting in the bank. The bank can't lend out because the demand is high. So the Federal Reserve started to cut interest rates as they do in monetary policy. Greenspan actually kept the interest rates pretty low, even with when the economy at the time. This is before 2008. In the after This is after the dot-com bubble burst, so it's between 2000 and 2007. In that time period, instead of raising interest rates, he kept them low, which facilitated more of this lending. So credit became easy. Uh, Banks were reducing their underwriting criteria, softening their sense of things. The shadow banking industry was growing with even more chicanery and smoke and mirrors, and the ninja magic of loans going on made it easy. We had a trade deficit. There was a higher incentive. Um, we had a $500 billion annually that was exported more than imported. That was funneled back actually in when we export. The products are purchased, the money comes back here. So higher exports also is a higher inflow of money. So inflow of funds and exports are one thing. Imports and the outflow of money is another thing. So if you separate the two, an export is the good side, the inflow is the financial side. And if the domestic interest rate is lower than the interest rate outside of the country, then more money is going to come in. And if our prices of our products outside the United States are cheaper than in that country than the domestic price for that in that country, then we're going to export more. So that is a positive export and a positive inflow of money. Well, the opposite. We're flowing more products in and we were exporting jobs. So we weren't making any products at that time. China was increasing their production. Um, in China, after Mao Zedong um, ushered in the communist regime and turned China into the largest communist nation in the world by population, the he was basically considered the first generation. Then Ding Jiangping um, was basically the second generation and turned it around, uh, opened the borders back up as the Mao Zedong closed the borders of China and kept everything internal with no trade with any other country, basically. What Deng Xiaoping did was open the borders back up, increased exports, reducing imports, but increased exports because he monopolized or capitalized, I should say, on um, the number of workers. With 1.2 billion people in China, there was a lot of resources available that were underutilized. And he saw that the underutilization of the resources that China had was actually stymied the growth of China and China's economy. So what he did was he encouraged more foreign investment, which used more of the Chinese resources that were available. It increased its production possibility, widened it out, actually shifted it to the right, expanding it more so they were able to produce more because they were more efficient at the resources they had available. And the additional products they produced were able to export. We exported those jobs, those tasks of making or manufacturing to India and China, mostly to China. India was more of a tech export, and China was more of a manufacturing export. China export we exported jobs, the manufacturing jobs to China and built factories there to make our products. India handled our services and tech side. But we both countries were the recipients of these exported jobs, which reduced the uh, money here. Um, so another thing that Hyman Minsky warned was called the illusion of tranquility. The illusion of tranquility um, was what Greenspan basically, and many economists were feeling at the mid after the dot com. There was no until 2007. There was nothing else going on. I mean, everything was a really plentiful thing. Well, I shouldn't say that. 2001 was 9/11. The war machine started. We had war on two fronts: in the war of Afghanistan, the war in Iraq. Um, we had those two wars going on since 2001, actually 2002, and so the four or 5 years that since then was not a lot going on, but business wise, the economy wasn't really in the doldrums, and so there was even more, and we had a Republican president, which was George Bush Jr., a strong Republican Congress, and a more conservative classicist in the Federal Reserve. So we had fiscal policy, uh, predominantly a conservative fiscal policy of deregulation. We had monetary policy of reducing government spending, not changing the taxes so much, but reducing government spending and continued deregulation, lack of enforcement of current regulations, lack of oversight, excessive trust in the banks monitoring themselves, where Federal Reserve, in this case, Greenspan, the Federal Reserve, was the banker's bank. Not just the banker's bank, the banker's regulator. And he was leaving that out. Again, this the tranquility was banks are handling everything by themselves. They're doing great. Things are looking fine. people are getting homes and buying homes. We don't care what they're saying, how they're getting it. I'm just seeing that there's new home starts are going up, and people are buying homes and getting into homes that look great in places that were high, what we would have called high income locations. This is fantastic. So continued deregulation and lack of lax regulation. Um, and trust in banks actually started more in the Clinton administration in '95 with the Glass-Steagall Act, um, which lifted the ban on interstate banking and made the banks able to cross state borders. So you had interstate banks becoming even larger banks. Um, the This facilitated even further with higher debt. A high debt burden obviously is surely problematic because if there's a lot of debt, it limits these options that we have available if there's a crisis. So the high debt burden that the government had by reducing taxes and reducing spending, that reduction in spending, but the reduction in taxes had much of more of an impact on the deficit. So there was continued deficit spending at this time, which means the government had to borrow, as we talked about in chapter 15. Now, I hope you haven't noticed so far, and we have several slides left in this lecture, several pieces of the crises, several causes of the crises. I don't know if you've noticed that we've already touched on several of the 10 tenets right now. Um, Up to this point, and we've only come to point 12. Point 12, we already noticed that people weren't rational people respond to incentives, but we have an irrationality here. The irrationality is well, a rational person would say, yes, if you are able to give me a loan for a low interest rate of 1%, I will respond to it. But the reciprocal point of that rationalization is, why would a bank a loan lend someone under ninja rules? No income, no job, no asset. Uh, Even if it's 1%, I'm offering you because I'm trying to get you in the door and I'm going to jack up your price. That's the predatory. Um, so there's an incentive, and the rational person would follow it, but there's got to be an irrational side to this. And there is a level of irrationality that actually outweighs the rational because want a house. I'm going to get this house and I'm going to go after this 1%, but you can't afford it. Who cares? The bank's going to give it to me anyway. Um, then we have the concept of financialization, which refers to the growing focus or importance of the financial sector without focusing on manufacturing. It it's been going on for 30, 40 years, where we've been exporting jobs to cut the businesses are exporting jobs, manufacturing jobs to countries where there's a lower wage, like Mexico, like India, like China, like other Southeast Asian countries, and manufacturing them there at a lower cost, and then importing them back to the United States, the finished products, to sell here at a great profit because you saved cost. These manufacturing jobs, the financialization of the markets, focused that the, changed our focus from thinking about manufacturing. If you look back in the 50s, um, we have in a previous video. I had, I think it was chapter 8. More than half the video was Diego's mural that can be found at the DIA, the Detroit Institute of Art, that Diego Rivera had painted on the walls of the DIA, was commissioned by the DIA to paint this. One of those section of that mural was part of that video, of the Ford plant, basically, of the workers in a Ford plant. And the conditions, the working conditions they had. That was done, in the 50s, where we still had a focus on manufacturing, but that had shifted to more importance on the financial industry. And we basically putting all our eggs in one basket instead of thinking about it. The financial industry accounted basically for about 4% of GDP and 17% of corporate profits in 1980 alone. But as this importance doubled by the early part of the 21st century, after 2000, to 8% from 4%. And corporate profits averaged 27% between 2001 and 2007, just before the Great Recession. So the financial industry was growing as a proportion of GDP. So where we talk about GDP as the finished goods and services, now we're kind of reducing how much goods there are and increasing the amount of services. So you see that shift.